Welcome to the Trestle Bridge Capital Market Observations Call. Today is Tuesday, June the 6th, 2023. I'm your host, Eric Jefferson. Before we get started, quick historical note. Today marks the 79th anniversary of D-Day. Important to remember all of those involved in these sacrifices that they made. On a side note, anyone looking for a great example of leadership, take a look at President Eisenhower's speech that he had drafted that he prepared to give should the Allied forces not have been successful that day. A great example of what we all look for in our political leaders. A lot to discuss today. Before we get started, though, have a few quick words from our legal team. With that, we can go ahead, dive right in, and want to start by recapping markets last week. Saw stocks up, bonds down. And that was following a slew of mixed data. On the encouraging front, first and foremost, glad to say, relieved to say that we've navigated the debt ceiling. That was officially signed into law by President Biden last week through an agreement with House Speaker McCarthy. The plan there, we will spend $4 trillion over the next 2 years, then push this out to January of 2025, once many of the existing politicians' re-election efforts are in the rear view. Turning to the economy, with respect to labor, that remains very strong. Granted, did get an uptick in unemployment, but payrolls came in way above expectations. Again, time and time again, that has proved to be resilient, despite a number of those leading indicators beginning to soften. Those leading indicators are designed to forecast or predict where the economy will be going from current levels. With respect to the banking crisis, clearly that has turned out not to be the concern, the tail risk event that many had initially speculated. And then lastly, everybody's favorite topic, of course, being inflation, continues to make progress, trending lower. Granted, though, the stickier components of that haven't moved as much as we would like. That will certainly be interesting as we get further along, trying to make progress towards that long-term average. As we think about the overall environment, though, last week, the environment of good news is good news, helped to benefit stocks. Unfortunately, though, that worked against bond investors, given the strength of the overall economy. There's now increased speculation. We may, in fact, get another interest rate hike or two. Next week on the 14th, the Fed will meet. My expectation, they will keep rates where they are. Not to suggest that there couldn't be one or possibly two additional hikes over the course of the summer, but in all likelihood, vast majority of these hikes now in the rear view, which from a positioning standpoint makes bonds fairly attractive. Again, it was their interest rate sensitivity or their duration that worked against them through most of last year as interest rates marched higher. The silver lining of higher rates, you can now earn a fairly attractive income owning bonds. And then at some point when rates are cut, that duration will work in your favor from a total turn standpoint. One interesting aspect to acknowledge, currently the bond market is pricing in a series of rate cuts for the latter half of this year. From the seat I sit, view that as being very unlikely. One of two things would have to happen. Either the economy implode or inflation magically drop back down to that 2% average overnight. Give a very low probability to both of those, which makes it very interesting to see how things will play out. Conversely, stock market, though, continues to grind higher, apparently not at all worried about a potential slowdown. We've not seen any revisions with respect to earnings forecasts. And one of the themes continue to talk about here is the resiliency both of the economy and of stocks. Granted, overall market is grinding along, positive growth, albeit slowing and below trend. Granted, that is in spite of China that has recently come back online and yet to really contribute to overall growth. But when we think about stocks as a whole, where they're not showing any signs of potential concern, I do think that makes them somewhat vulnerable if we do get a slowdown. Then again, though, should we continue to march through it, no reason to expect that this existing rally may not have any further legs. One interesting theme we discuss with respect to the stock market in this month's Asking for a Friend is the impact of artificial intelligence. That was something we heard from CEOs in virtually every industry and sector talk about incorporating AI, the benefits that they anticipated having on their businesses, on their productivity. But interestingly enough, as we look at the performance of underlying stocks on a year-to-date basis, it's really only about a dozen or so the mega cap technology names directly tied or manufacturing that AI and its components that have really benefited from all of this craze, all of this buzz around AI. We actually look at the average stock in the S&P 500 this year, only up about 1%. That is obviously a fraction of the index as a whole. Again, that's a function of some of these mega cap technology names really leading the way. Again, a theme that we discuss in this month's Asking for a Friend. On the topic of big tech, Apple just released their latest headset at the Worldwide Developers Conference. This has been touted as the headset to replace the desktop computer. Comes with an infinite number of virtual screens to navigate multiple topics or tasks at any given point in time. It's also touted as having more pixels than a 4K TV. That can be yours for the low price of $3,500. Then finally, from a positioning standpoint, did recently make some changes to the portfolios. Our stance currently today could be best described as cautiously optimistic. One of the recent positions, an allocation into Japanese equities, we discuss in more detail. That can be found in this month's Know What You Own. That position, based on what we believe to be very attractive forecasts for growth, paired with very attractive valuations relative to not only global markets, but particularly in the US. That's all for this week. As always, happy to discuss anything in more detail. If we don't connect, have a great rest of the week. Take care.